Undervalued stocks are catching the eye of smart investors in 2025, especially as much of the market remains obsessed with high-growth tech names. But while some sectors are stretched in valuation, there are still opportunities to buy quality businesses trading below their intrinsic value. In a market where patience is rare, value investors may find outsized returns by focusing on fundamentals, long-term cash flow, and strong balance sheets rather than short-term sentiment. One example is Intel. The stock has underperformed the broader semiconductor space, largely due to execution delays and competitive pressure from AMD and Nvidia. But under the surface, Intel has been restructuring its business, investing heavily in US-based chip manufacturing and shifting focus to its foundry services. While the market remains skeptical, long-term investors are taking notice of Intel's transformation. The company trades at a forward price-to-earnings ratio around 12, far below its historical average and peers. Its dividend yield near 3% offers additional income while the turnaround takes place. Another overlooked company is 3M. The stock has fallen sharply over the past few years due to legal liabilities, primarily related to earplugs and PFAS lawsuits. But the company is stabilizing. It recently spun off its healthcare business and is implementing cost reductions. Despite the negative headlines, 3M remains a globally diversified industrial company with robust free cash flow and strong margins. With a forward PE near 10 and a dividend yield above 5.5%, it offers a compelling entry point for long-term investors who believe in corporate restructuring. Warner Bros. Discovery is another name trading at depressed levels. Following its merger, the combined entity struggled with debt and streaming platform integration. However, it's now showing signs of progress. Free cash flow has improved significantly. Management is aggressively paying down debt, and content monetization across franchises like DC, HBO, and CNN is stabilizing earnings. The company's valuation remains heavily discounted compared to other media conglomerates, making it an asymmetric bet on execution and patience. CVS Health has quietly become a healthcare powerhouse, expanding into services and insurance through acquisitions like Aetna and Oak Street Health. Still, the stock trades at a low valuation due to concerns about reimbursement pressures and rising costs. The market appears to be overlooking its vertically integrated model, which could become more valuable in a cost-conscious healthcare environment. CVS trades at a PE below 9 and offers a dividend yield of over 3.5%, with improving cash flow generation expected in the coming quarters. CIBC, one of Canada's major banks, has underperformed its peers largely due to a larger exposure to the domestic housing market and concerns about consumer credit. However, it remains well capitalized, profitable, and pays a dividend close to 6%. With a PE under 10, the stock trades at a significant discount to its historical average and to its Canadian banking peers. If interest rates stabilize or decline, CIBC could benefit from margin expansion and housing recovery, leading to multiple re-rating. Pfizer is another name that's been beaten down after its pandemic-related revenue boost faded. With declining COVID-19 vaccine sales and pipeline execution concerns, the stock has dropped over 40% from its highs. However, Pfizer still generates significant free cash flow, has a strong balance sheet, and is investing heavily in next-generation therapies, including oncology and mRNA platforms. Its valuation now sits at a PE under 9, and the dividend yield is over 5%, offering investors solid return potential once the pipeline matures. AT&T has long been a controversial value pick, weighed down by past management missteps and debt from acquisitions. But it has refocused on its core telecom operations and now generates over $15 billion in annual free cash flow. Despite this, the stock trades with a PE of around 7 and offers a dividend yield above 6%. With much of the bad news already priced in, investors looking for a steady cash-generating business may find AT&T attractive in a high-rate environment. Bristol Myers Squibb is another pharmaceutical giant that has been trading at depressed valuations due to concerns about patent cliffs and biosimilar competition. However, it has a deep pipeline and multiple partnerships in immunology and oncology. The company's cash flow remains strong, and it is buying back stock aggressively. With a PE near 8 and a yield above 4.5%, Bristol Myers offers a mix of value, stability, and long-term growth optionality. Kraft Heinz is often dismissed as a legacy brand in decline, but it has quietly improved its balance sheet, stabilized revenue, and optimized supply chains. While growth is modest, it still generates healthy margins and strong free cash flow. Trading at a forward PE under 11 and with a dividend yield near 4.6%, Kraft Heinz provides defensive exposure to the consumer staples sector with limited downside and moderate upside. Finally, Barrick Gold is a unique play in a world of monetary uncertainty. The stock has lagged as investors rotated out of commodities, but with gold prices near record highs and inflation still elevated, Barrick offers leveraged exposure to the metal. It has low production costs, declining net debt, and improving returns on capital. The stock trades at a PE below 12 and offers a dividend yield above 2%. For investors who want to hedge with upside, Barrick could serve as both a defensive and opportunistic pick. The broader market may not be cheap, but these undervalued stocks offer specific entry points where the price does not reflect the full potential of the business. Whether it's a turnaround story, a defensive income play, or a misunderstood segment, each of these companies trades below historical and peer valuations with catalysts for re-rating. With earnings growth, margin improvement, or simply reduced fear in the market, these names could deliver strong total returns over the next few years. As always, make sure to do your own due diligence, manage risk, and focus on long-term fundamentals. If you found this analysis helpful, be sure to like and subscribe for more weekly insights into value investing, stock picks, and market strategy.